Good morning, everyone. Thank you for tuning in. I'm really excited for today's show because today I have with me Professor Andros Gregoriou, and he is an expert in liquidity and how liquidity works. So I'm really looking forward to this. I've been studying how liquidity bonds work and how asset correlation works for a couple of months. Really, like since I started paying attention to what Richard Hart calls Hart's Law. So I want to ask, I have several questions for Professor Andros Gregoriou, and I'm going to add him to the stream right now. Hi.
Hello, how are you?
Good, how are you?
Very well, thank you.
Thanks for being here this morning.
Thank you for inviting me. Thank you for inviting me.
Sorry?
Thank you for inviting me.
No, thanks for coming on so last minute. I was surprised actually when Bruce wrote me last night and said that you could come on this morning. I was like, wow, that's amazing. So anybody who is watching, good morning, Bruce. Morning, everyone else who's watching. So some people may have seen when Bruce Porter Jr. came on this show. It was like maybe a month or two ago. And we were talking about, a little bit about Evai, a little bit about, industry time in the industry. And he mentioned that on the team, there was a liquidity expert. And that's why I was like, I have to talk to that person. So I've been kind of like getting after him to get in touch with you ever since. And I'm really, really excited that you're here. So do you want to briefly give an introduction to like who you are and how you became a liquidity expert and what exactly that means?
Sure, absolutely. My name is Professor Andros Gregoriou. I'm a professor of finance, a full professor of finance since 2008. And my research is actually built on essentially building liquidity models. And that goes from measuring liquidity when there's news or events to actually building my own liquidity measure, which we use with the Evai ratings platform, and essentially how liquidity goes into asset prices, returns, etc. And essentially, I've taken that research and adapted it to the cryptocurrency space. And obviously, we've developed the world's first unbiased ratings platform built on AI and ML, artificial intelligence, machine learning, that is free from human bias. So I'm a real expert in liquidity from the perspective of how you measure liquidity, to my own liquidity measure and what liquidity is and what it means and how important it is, etc. So essentially, I've built up that research over the last roughly 20 years. So liquidity is one of my real fields that I've developed.
Awesome. Well, I'm really looking forward to this conversation. So I want to get like straight into this question because I think that it's what like most of the people who are watching right now are going to be interested in, and then we can delve a little bit deeper into how the AI works. And by the way, anybody who is curious about this, Hex is listed on Evai's platform. So we're definitely, getting something out of this relationship. So don't be mad, okay? Some of the people who watch this are really really against trading and really against really other crypto assets in general. So I like to preface everything by saying none of what we're saying is an attempt to try to convince anyone to buy anything ever. We're just having a conversation.
Yeah, education, conversation, understanding of the area and what we're doing, really. This is what the purpose is. Absolutely.
Yeah. So let me just preface this. The founder of the cryptocurrency that most of the viewers of the show are biggest fans of his name is Richard Hart. And he said that he figured out the way that liquidity correlation works is by the asset that it's most tied to. So he says that, Hex is decorrelated from the rest of the cryptocurrency market because unlike most other assets, it's not tied to Bitcoin or Ethereum. It's tied to the US dollar. So I've been working at a decentralized exchange for about 6 months, and I have watched the trend shift from everyone wanting their liquidity tied to Ethereum or Bitcoin to everyone wanting their liquidity tied to the US dollar. So it definitely seems to be a trend, but whether or not that's really a correlation is kind of up for debate. I was curious about your perspective on that.
Well, I think that's very interesting because essentially correlation and liquidity correlation can mean a variety of things. So obviously, on the one hand, if you're tied to Bitcoin or Ethereum or to the US dollar, whoever you're tied with, obviously that's going to be a correlation for obvious reasons. So you're obviously going to have a trend where if the US dollar changes, then obviously your cryptocurrency will change, etc. Now, in terms of liquidity and correlations, there are various ways to do this. One of the ways is to identify liquidity risk for your cryptocurrency, and you can use the ratings platform, for example, for that. And in particular, you can use various liquidity measures, and then you can look for other cryptos that will have a negative correlation with your crypto that you're interested in, and that's a way of hedging risk. So essentially, when yours goes up, that goes down essentially, and that's really Markowitz's sort of modern portfolio theory from the 50s, really. So you can look for simple Spearman's rank correlations, and you can look at the factors that interest you and look for these negative associations. So when you are losing money in Hex or whichever one you're interested in, you're not losing as much because you're gaining on the others. And that, to some extent, is the whole portfolio theory element. So that's obviously with your pair, which is what you're essentially saying, you're going to get a direct correlation. That's obvious. But I think that's the way of doing that. Yeah.
So I guess that's the real question. I actually have a clip of Richard talking about what he calls Hart's Law that I kind of wanted to play for you so that you could get a better idea of exactly what he means and sort of, yeah. So I'm going to add that to the stream. And you know what? This is really obnoxious. The sound is not working. Can you hear it?
No, sorry, I can't.
Okay.
It seems paused at the moment.
Yeah. But see, so now it's...
No.
You can hear it?
No.
Okay. Well, that's unfortunate. I really wanted to play this, but for some reason, the sound is not going on. So what he says in this clip, essentially, is that, that when you have an asset that's tied to Bitcoin, when Bitcoin's value is going up, that asset's value is going to go up with Bitcoin because it's tied. So that is the case. That is true.
Yes.
Okay.
Yeah, absolutely.
All right. So guys, here we
have... And the same for Ethereum or whoever you're tied with. Yeah,
sorry?
And the same if you're tied with Ethereum, for example.
Yeah, exactly. So there we go. Okay, there's confirmation from a... Could you explain a little bit about how that works or why that works?
Well, essentially, if it's tied to a certain asset or if it's tied to a financial instrument, then by definition, as that financial instrument essentially changes in one direction, then you will change along with it. I mean, that's essentially what it is. You've basically got direct correlations. You've got positive correlations between who you're tied with, essentially. And that's true. But I think you can make this a much broader perspective. So I think you can actually play around. So if you're interested in a certain type of cryptocurrency, which obviously your investors seem to be, then that's good. But what you can do is you can look for other currencies that are traded that have negative correlations with your currency, whether that's on returns and so on. And then you can
hedge your risk there.
Portfolio to do risk management. Because I think this is what, to an extent, we're getting at, in that, if Bitcoin goes up, you go up, for example, and the opposite. So where's your risk management against Bitcoin? Well, there isn't any. And in a way, you can use that and build portfolios. And I think that would be really interesting. And I think your investors can gain bigger returns possibly by doing that.
That is really interesting. So when I had Bruce on, we were talking about what Evai's liquidity is tied to. And he said that actually changes. So is that the case? Like the liquidity, what it's tied to changes, like the pairs that it's primarily tied to changes based on what the AI believes the market is going to do?
Yes. I mean, with Evai, we're a bit different from the perspective that we're a financial ratings platform. So we are using liquidity as a factor for risk, essentially. And we're actually able to devise liquidity measures based on my research. And we're able to rate cryptocurrencies, not on their pairs, but on their liquidity risk compared to their past. So it's a slightly different perspective. So it's looking at it much more from a sort of financial returns point of view, rather than a sort of pair. And the thing with Evai is ever changing, because A, we're doing that, and B, because we're listed on different platforms and so on, then obviously the pairs change, and it obviously makes us more robust in terms of liquidity risk. Yes.
Yeah. So one question that I really have is with pairs like that are traded most frequently on decentralized exchanges where anyone can create a pair. Is there any risk that like just bad actors could come in and tie the liquidity to something that maybe you don't want it tied to? Or does a foundation or something control a majority of the supply so that isn't a concern?
Well, I think that's potentially a possible concern. Yes, I think that is a concern, but I think that's where investors have to be careful. And I think the Evai's rating platform is something that they can use, to look at the ratings. But I think you need to see what it's paired to, and I think you need to see what the reputation that is paired to. So, for example, if it's paired to Bitcoin or Ethereum or the US dollar, well, that's obviously very reputable. So from that point of view, they've got reputation. If it's tied to something that doesn't have much foundation, then to some extent you have to ask the question, why is it tied to that? And then in a way, you have to look deeper into the asset and what the perspective is and what they're trying to achieve. So I think investors need to look out for that. I think that's very important.
Okay. All right. That's interesting. All right. So yeah, I'm really, really glad that we had this conversation. So, so that is how bonding liquidity works, right? Is by a primary percentage of the asset. Is there a specific number that needs to be, or is it just need to be the majority?
I'm pretty sure it needs to be the majority. I don't know what the exact number would be, but I think it needs to be the majority as far as I'm aware.
Okay. So in that way, centralized ownership of an asset could be really, really important to controlling an asset. So it could actually be looked at as a positive, where a lot of cryptocurrency looks at centralized ownership as a negative.
It can be a positive, absolutely. Absolutely. It's not necessarily a negative concept at all. Yes.
Okay, that's interesting too, because that is another point of contention with a lot of cryptocurrency. A lot of the industry believes that if, one entity controls more than 51% of an asset, that's a real negative for that asset.
Not necessarily. It depends what entity they're controlling. It depends what their philosophies are and what the perspectives are. It's not necessarily a negative thing.
Okay. And so your advice would be to hedge your portfolio, that it makes sense to hold assets that are oppositely correlated so that no matter what, you're going up.
Yeah, I mean, if we look at financial markets, if we for a moment disregard the crypto market.
Yeah, sure.
And if we look at what financial markets have been doing since the 60s, is they've been hedging risk through portfolios. And I feel this is something that the cryptocurrency market is currently not doing. Because essentially the majority of people are investing in very few assets. And as you quite rightly said, these assets are paired in a way. And essentially they're paired to either a major currency, as in the US dollar, or they're paired with Bitcoin or Ethereum. And essentially the market is moving in one direction, up or down. And that's why when we look at the market, we tend to get a surge up or down, really. What I think investors need to do is they need to allocate the vast proportion of their money where they want to invest, but then they need to look for hedges. And essentially they need to look, and they can look at different factors, and they're more than welcome to look at Evai and look at our factors, things like returns, things like minimizing risk, volatility, liquidity is another one, momentum's another one, and there's various others, for example, that they could look at. Moving average is another one. And they could actually look at their asset, take the data, and devise negative correlation with other assets that they don't necessarily want to invest in. But they do invest a small proportion of their money there, and therefore they end up making more money on the asset that they want because they're hedging their risks. And I think that's really, really important for people to start doing. And this is something, for example, with Evai that we want to do because we want to create a market portfolio. So we want to avoid these issues of it's paired with Bitcoin or it's paired. And we want to just say, right, this is the cryptocurrency you want to invest in. Hex, for example, how is it doing compared to everyone else, where you have a value-weighted market portfolio and you can see your performance with that rather than it's paired with so on and so on. So this is something I feel that investors need to do. And, if people want any advice, I'm more than happy to discuss it with them and ways that you can do that to try and utilize the return on Hex or whoever you want to invest in. Yes.
All right, guys. So anybody has questions, feel free to drop them in the chat. I am paying attention, and I'd be happy to throw them up on the board if anybody's got them. So what else can you tell us about Evai for people who may not be like really interested in managing their own portfolio risk? Because Evai itself is going to be a fund, right? A UAE fund.
Yes.
Okay, so tell us about that.
So I think with Evai, it's up to the individuals to decide how much of it they want to use. I think on the one hand, you could just simply have a look at the demo and look at the ratings of cryptocurrencies, or you can actually use the fund without obviously promoting Evai. I think it's a really good idea in that people can essentially have a fund that will be regulated, and it will be the first financially rated cryptocurrency through the United Arab Emirates. And essentially, Evai will essentially manage a fund for you using essentially the model that we have created. And we will use that to essentially give you a fund for cryptocurrencies. So we're able to do the sort of risk management on your behalf, and we're able for you to obtain the best possible returns based on essentially a hedged portfolio with risk management using the ratings platform. So my personal opinion would be to encourage people to have that. Because as we know through conventional financial markets, that if you do have a well-diversified portfolio, you will earn higher returns with lower risk than if you just have all your eggs in one basket. And this is really one of the things that we're trying to do with Evai. As well as educate people and as well as people seeing the ratings, we want people to essentially invest in cryptocurrencies without fear. We want them to have the knowledge. And we want them to have well-diversified portfolios, like an investment bank with conventional assets, where they're able to obtain the highest return for the lowest possible risk, because we want investors to be rewarded. So if you do want to buy HEX, then that's great, but have it as part of a fund where you've got other assets that will get you the highest possible returns on your asset for the lowest possible risk. And we're using research, not just my research, obviously. We're using research that's been around 100 years. We're using research that has been tested on conventional equity markets with data from the 1920s. So this is really research that is well-founded and research that is well-established that we're basing this on. And there's a logic and there's an academic discipline behind it. And it's clearly been well thought out. And it will earn people more returns, definitely. We are very confident of that.
And Evai, sorry, I keep saying it how I want to pronounce it, but I seem to be pronouncing it incorrectly. So I keep saying Evai, and you're pronouncing it?
Evai, yeah.
Evai, okay. Evai. All right, so Evai did outperform the market in this most recent downturn, didn't it?
Yes, significantly so. And yeah, it did, which we're very proud of. It outperformed the markets. When some of the big players like Bitcoin and Ethereum went through a huge downturn, we were very, very stable. And that really believes that, and that's because people believe in the concept. People believe
the same was true for HEX, by the way.
Yes, it was. Absolutely.
Oh, so you have been watching. Good.
Yes. People believe in the concept, believe in the team, and the idea of us really is to add value. We really, really just don't want to be another cryptocurrency. We want to add value to this market. We want to add education, credibility, and we want this. This is the future. We know that. And we really want to make a huge value to this market and for people to use our models and also to help us and say, because there's the cryptocurrency investor is very experienced and often will say to us, well, why don't you include this and this? And that's fine. If we can have data, we are happy to talk to the community. And that's another input that we would like from you, if possible. Anything else they want us to look at. And it's based on data. There's no human bias. There's not me saying I know everything and this is the way it is. It is purely driven by data and purely driven by machine learning and artificial intelligence, and it's completely unbiased.
So I do have one thing, is that I'm not sure where the data platform is pulling information from, but it's not pulling market cap and it's not pulling circulating supply for HEX. So I'm just curious about where that data is coming from, because I would like to see the most accurate data.
That's a very good question. I mean, we are pulling data essentially from exchanges directly. But I think one of the things that we need to be looking at, and one of the things that we are currently doing, is looking at the blockchain itself, which is maybe a more accurate position to be in. But we will get the most accurate data. Coin market cap is one thing we can use. We can use Coinbase. We can use various places to pull data from. So I think, yeah. So
there's some contention within the Hex community, and that's starting to spread throughout cryptocurrency, which is that coin market cap doesn't report the most accurate data.
But that's fine. That's something that we will look at.
Okay,
that's
good.
Useful from your point of view, and that's something that we will look at. And if there's a more accurate database, then of course we will use it. But we're using a variety of databases. We're not just we're looking at the exchanges themselves. We're looking at bits of the blockchain. So we're looking at various sort of data sources. But what I think is important, and I think the community needs to help us from that point of view.
Yeah,
if
I agree.
we believe there's a more reliable data source, we will look at it. And of course, if we believe that's true, then we will use that as well, or instead of. So we're open to that.
So let me advance one right now.
Yeah.
Nomics.
Yes. Sorry?
Nomics is one that I just wanted to advance.
Yes.
Yeah.
Okay. Yeah.
As something to look at, or at least one
something to look at. It's something
point to consider.
Yes, of course. We will consider that. Absolutely.
All right, so we've got a question from the audience, and it is Crypto303 asks, what is the biggest factor in the Evai rating?
It's a very good question, Nat. And there isn't, it depends. I mean, the answer to your question is what we do is we have various factors. And then the AI essentially picks out the optimum weights of each factor. And the answer to your question is it depends on the cryptocurrency that we're rating. There isn't one universal factor. So depending on what we're rating, everyone has a different dominant factor. Sometimes there isn't a dominant factor. You might get something that's quite sort of equally weighted, if you like. So the answer to your question is it's driven by data, and it depends on which currency you're rating. There isn't an obvious choice. There isn't an obvious dominant factor, because the way we run Evai is initially we do everything equally weighted, and then the AI picks up the optimum weights for each factor. And it depends on the data. It depends what we're rating. So the answer to your question is we don't know. It varies. Is the answer.
Okay. Well, that's a great answer. That should be the answer. It should vary, right? So,
yes, I mean, to answer your question, sometimes you may have a dominant factor. I mean, it's possible in research, but in terms of in this space, it does vary. And obviously, as the data comes in, it changes all the time. So there isn't an obvious dominant factor that we are picking up through our research, which is what I think the individual has asked for. So we haven't picked that up yet, and it does vary.
Okay. So another question back to this, Hart's law that I was asking you about, if the liquidity works like that. So I was curious, because it seems to be the case that very few people realize that is how bonding works. And I'm wondering why that is little known.
I think it's little known because I think for example, when you say liquidity bonds, people in the academic community automatically assume bonds, in conventional markets.
Right, we had this conversation last night. Yeah.
Yes. And the first thing you think of is liquidity bonds are something that, or if it's triple rated, and is there enough liquidity in the market? I feel that with the cryptocurrencies, one of the things that I think the cryptocurrency community needs to do is to tell people how the liquidity sort of pools and bonds essentially works. And it's all about sort of pairs and what it's paired against and what the philosophy is against that. So I think people need to know more about that, really, because and I think the terminology doesn't help. A liquidity bond, because people automatically think of that as conventional bonds and AAA rating and things like that. They don't automatically think of essentially pairs of liquidity, which is what we're saying.
If you had a single source to point to someone who wanted to learn more about that so that they could explain it better, what would it be?
It's a very good question. I haven't managed to find anything as such, but I'm, if required, I'm more than happy to write a small piece about that and post it for people. But I haven't found the reliable source for the cryptocurrency market as yet.
Oh, I mean, I was thinking that we could, that it doesn't necessarily have to be specifically about cryptocurrency, but it could just be more general and, with the application to cryptocurrency.
Yeah, I mean, in terms of liquidity pools, then I mean, my advice would always be to look at the academic research, and I mean, I would go to Google Scholar, and then from there you're able to locate some of the interesting research that's been done in sort of liquidity bonds, and you're able to have a look at that. And I'm more than happy if people are reading academic papers. If they've got any technical questions, to by all means speak to me. Yeah.
Okay.
Yeah.
Great.
Liquidity pace does sound better than bonds. Sorry.
You think so? Okay. So that's interesting, because I like bond better, but I can understand why that would be confusing.
Yeah. I mean, liquidity pegs, I think is yeah. I mean, bonds, you always think of bonds, but yeah. Liquidity pegs does make more sense. Yeah, I would agree with that.
Okay.
That's what it is. Yeah.
All right, guys, if you have any more questions, drop them in the comments real quick. I want to ask you, before I let you go, and before we see if there are any more questions, is there anything that I didn't ask you that you want to share?
For myself?
Yeah.
I mean, the only thing really I want to share is that, with Evai, what we're doing is based on research. We have got a ratings platform. It's continually improving, and we want your help in terms of factors that you want us to consider that maybe we're not considering, and on data sets, because to some extent, you know a lot more about the data sets, because you're experienced in the market. And we really want to make this the best possible ratings platform. We want to be a regulated fund, and we want this to be the basis for everybody who wants to invest in cryptocurrencies. And we want everybody to use this and to take advantage of it, and to essentially try and make as much money as you can out of it. That's what we really want. So this is what we are. It's based on research. Have a look at the white paper. If anybody's interested in the research behind it, by all means, look me up, Google me, have a look at my research, drop me a line. I'm more than happy to have a chat with you. I'm more than happy to tell you where everything is based and what we're basing it on. And, we want your feedback, because with all research, it gets better when you get feedback.
Yep. So people are saying kind of the same thing that I was saying earlier, is like, can we at least can we advance the suggestion that we look at nomics for correct data? And then several people have commented that. And then someone says, Evai has hex showing no market cap or circulating supply. So can we just?
Yeah, and that's the answer to your question with that is thank you for your feedback. We will look at that. Absolutely. This is one of the reasons that I do these is obviously to get the word out, but also we want feedback. So yes is the answer. We will look at that. Thank you for your feedback. And of course, we will do that. Thank you.
So that is one of the reasons why I felt comfortable accepting when Bruce asked me to come and, do a little bit of work with Evai, is because I was, looked a little bit into the background of the project, and I was like, I think that I can make this work. I don't think that this is a conflict.
No, not at all. I mean, from our point of view, we are here and we're here to stay, and we want to develop something great. But I think with all research, we have to have feedback from you. So for example, those questions about the data sets are really useful to us, and thank you, because we need feedback from you guys. And then from that, we're able to improve and hopefully add more value to you. So we are open to these things, and we do want your feedback. We need your feedback anyway.
Great. Well, I think you're probably going to get quite a bit of it after this.
I am here. I will answer any questions that you have. I will accept any sort of feedback, also criticism, but feedback. We want that. And yes, please just feel free to get in touch with me. I'm very approachable, and I like to be approached, and I want to engage with the community as much as possible. And thank you for your questions. I mean, the data questions in particular is something that we have to look at. Absolutely.
Well, thank you so much for being here. This has been a great conversation. I like to close this. My show is called Building Bridges. So I like to ask everyone if they will build a bridge with me at the end. So it works like this. Yeah. Will you build a bridge with me?
Absolutely.
Okay. Put your arm like this.
Oh, sorry.
Yeah. There we go. Yeah.
Done. I'm building a bridge with you.
Thank you. All right, we've got a bridge built. Thank you so much, Professor Andros Gregoriou. Thank you all so much for spending your Saturday morning or whatever time of the day it is with us. And I'll see you on Wednesday.
Yeah. Thank you, everybody. Take care. Bye-bye.